Welcome! Pacific Trading Academy presents Mentor Mike Bridges' Day Trading 101, How to Make a Living in the Markets, Part 1. This video is being made without a live audience. Due to some technical problems with my internet connection, we had to postpone the live presentation. But I'm going forward here and making this video, and hopefully once service is restored, it will be posted to my blog page on the Pacific Trading Academy website. I want to apologize most sincerely to anyone who was inconvenienced by carving out time from your Saturday to see the live show only to be told that it wasn't going to happen. I'm very sorry for that, and hopefully you'll find something of value here today that will at least make up for it in part. Okay, let's go forward. Now, for those of you who don't already know me, I am Mike Bridges. I'm a California lawyer specializing in financial planning. I've held a variety of FINRA licenses, Series 3, Commodity Futures and Options, Series 7, General Securities, Series 66, Investment Advisor. I've also held some California insurance licenses in life, accident, health, and variable contracts. But the thing that I've enjoyed doing most for the majority of my adult career has been trading and learning about the markets and teaching others about the markets. I've actually been trading since 1984, that's 30 years ago, and I've been teaching others since 2000, that is for 14 years. I've been a NFA CFTC registered commodity trading advisor since 2003. My favorite method and market is day trading the S&P E-mini. You're going to hear more about that today. My favorite platform is NinjaTrader 7, and my favorite broker is Trenton Kimino at Global Futures in Encino, California. Now, my one concession to social media is that I am a member of LinkedIn, and this is my public profile on LinkedIn. If any of you are LinkedIn members and have not already connected with me, please invite me to do so. I post a lot of my trading information here, including upcoming webinars. You can also reach me very easily through the Pacific Trading Academy website. If you go to the blog link and then click on Mentor Mike's Market Movies, you will find a large archive of my postings over the last several years. And that's where the video of this webinar is going to end up later today, hopefully. Here's a posting of a video of a webinar I did last October 12th on my POV trading. That's price, oscillator, and volume. So there's a lot of good information there, and it's all free of charge. You don't need any special passwords or anything to access it. So please take advantage of that. Now, how do you eat an elephant? Why am I asking? Well, the answer, of course, is one bite at a time. And this old riddle is actually very indicative of my attitude towards learning just about anything. Any large task, like learning to trade, can seem overwhelmingly difficult at the outset. The key is to break it down into manageable chunks and then just get started. We can apply this proven technique when attempting to make sense of the chaotic motion on a price chart. Now, in this presentation, Day Trading 101, it's the first of a two-part series designed to help my fellow traders find answers to the following questions. What markets to watch and trade? What time frames to watch and trade? How to consistently predict market movement? How to maximize your win percentage? How to substitute mathematics for emotions? And how to systematically grow your account from beginner to Mentor Mike's gadget level. Huh? What is gadget? Well, the answer is it's Mentor Mike's Grand Day group of E-mini traders. And you're going to hear more about gadget a little bit later on today. Now, today we're going to discuss the first three of those questions. What markets to watch and trade, what time frames to watch and trade, and how to predict market movement. Now, one thing you really got to embrace right away is that trading is not investing. It is gambling, plain and simple. A lot of people gloss over that fact, but that's really what it is. Now, obviously, if you're going to be professional about it, you want to put the odds in your favor, but we are wagering on the direction that these markets are going to go, and you need to understand what you're getting yourself into before you embark on a trading career. I strongly recommend that you watch my video, What to Look For in a Trading Mentor. It goes into some detail comparing investing with trading and also suggesting how you can benefit from the assistance of a trading mentor. This is the link that will take you to the appropriate page on the Pacific Trading Academy website. If you want to pause the video and copy it down, you can, but it's easily found by simply going to the Pacific Trading Academy website. Again, blog, Mentor Mike's Market Movie. And this particular webinar was posted on February 15th of this year. So find your way to that date in the archives and feel free to watch. I think you'll get something out of it. Now, what markets to watch and trade? There are three main categories: stocks, futures, and Forex. They all have pros and they all have cons. But I personally prefer futures in general and the E-mini S&P 500 stock index in particular for the reasons that I'm about to share. There's problems with stocks. For one thing, there's thousands of them to choose from. How do you decide? In addition, stocks seem to be more subject to hype and emotions, and the public's perception of value is more easily manipulated. Think of Enron and WorldCom and some of the other egregious corporate scandals of recent years. Now, also, with a maximum leverage of 2 to 1, stocks are much more expensive to trade than either Forex or futures. Now, some stock lovers will immediately point out, well, options can increase leverage somewhat. Yes, but they still can't compare to Forex or futures. In addition, options add a potentially complicated additional layer of analysis to the trading process. Now, at the risk of alienating all you option lovers out there, I got to tell you this. Options were really invented as a hedge against the diminution in value of stock portfolios. It's insurance, basically. That's why the price of an option is called a premium, just like the premium of an insurance policy. Options were never really designed to be speculative instruments, but they've become that over time because brokers need new products to sell. Anyhow, don't get me started on that. That's a whole nother topic for another day. We also have problems with Forex. To begin with, a Forex broker is really a dealer. When you buy, you're buying from him at a markup, and when you sell, you're selling to him at a discount. Now, there's nothing inherently illegal or unethical about doing this. It happens in stocks too. Your stock broker can act as a broker, which is an agent, and in that case, he'll go out and buy the stock for you from some third party. But he might say, well, you know, the stock you want to buy, my company has that in its own portfolio. How about if we sell you our stock? Now, we'll mark it up so we can make a profit. That's the same amount that I would charge you if I were charging you a commission. So that's why a lot of stockbrokers are actually broker-dealers. You might have heard that term before. In futures, it doesn't work like that. The broker is a broker. He acts as your agent and has a fiduciary duty to deal with you fairly and to do all things that are in your best interest. But a Forex broker, when he acts as a dealer, which is essentially all the time, he's really looking out for his own account. And he's not acting in a fiduciary capacity towards you. So even though most are honest and there are statutory limits on the amount of the markup and the discount, still there's an inherent conflict of interest that doesn't exist with futures. Now, since 2010, leverage in retail Forex is limited in the U.S. to 50 to 1 on the major currency pairs and 20 to 1 on the cross pairs. Now, 50 to 1, 20 to 1 might sound like a lot to you, but it's not really. And there is no limitation on leverage in most foreign countries. And so Forex is really popular outside the United States. It's popular here too, but really popular in the rest of the world. But the problem is that if you go to open an account in Great Britain, for example, most foreign brokers have rules that say that they can't accept U.S. citizens as clients. So we're kind of stuck trading here with limited leverage. Also, even though Forex does not have commissions or exchange fees, the bid-ask spread tends to exceed futures transaction costs. So Forex is, again, more expensive than futures. Also, the bid-ask spreads can fluctuate, sometimes wildly, making it more difficult to calculate and use NinjaTrader's automated trade management strategies, which is very important to this type of trading that I do. Now, I don't want you Forex people to think that I'm totally against Forex. In fact, I appreciate the fact that most of the rest of the world really loves it. So you can see that back here on January of this year, I did a very nice webinar on Mentor Mike's money management for Forex using NinjaTrader's automated stop strategies. NinjaTrader happened to sponsor that webinar. I've done a lot of webinars for them in the past. I've got another one coming up on July 9th. So I'm not anti-Forex. I'm just saying that my personal preference leans towards futures. If you are a Forex trader, by the way, you might want to check this one out. Go to the archives, January 22nd. Now, I've talked a lot about leverage, so before we go any further, let's make a few comments about it. As you know, leverage means a relatively small investment that controls a much larger amount of an asset. For example, a small margin deposit controls an entire futures or Forex contract of much greater value. But the thing you got to really appreciate and understand is that leverage is the proverbial double-edged sword. It multiplies both profits and losses. But leverage is the only way you're ever going to turn a modest amount of capital into a significant amount of profit. You must not fear leverage. You have to embrace it and make it your friend. Now, we've talked about some disadvantages of stocks and Forex. Let me tell you what I perceive to be the advantages to futures generally. They have relatively high leverage, especially for day trading, and thus they're a more affordable place to begin for small account traders. Now, notice I'm not saying in any way, shape, or form that futures are safer or have less chance of loss. That is not the case. But it takes less capital to begin if you're a small account trader, and that's a fact. Also, futures are cheaper to day trade than Forex, despite the fact that futures have commissions and exchange fees. But the difference has to do with the wider bid-ask spreads that you find in Forex. Now, the other thing is I think futures are more subject to natural market forces like supply and demand, and less subject to the hype and manipulation that you find with stocks. Now, there's advantages to the S&P E-mini specifically within the realm of futures. For one thing, they have super low day trading margins, which creates super high leverage. They have high volume and open interest, and that creates a nearly constant one-tick bid-ask spread. This narrow spread makes the E-mini cheaper than Forex and also allows for the easy calculation of automated trade management strategies on NinjaTrader. And there's a whole bunch of other reasons, but one of them is it makes it easier to explain what you do for a living at the proverbial cocktail party. I trade the stock market. You tell somebody that, they have an idea of what you're doing, and they kind of leave it alone after that. You ever tried to tell somebody, well, I trade futures or I trade Forex? Chances are, unless they're a trader themselves, they're not exactly sure what you just said. And then they're going to ask you to be polite and you know, oh, what exactly does that, you know, and then it's going to be, oh, what are you talking, like pork bellies, man? What, you know, and it ends up being a discussion that you don't really want to have, and they don't really care anyway. But I trade the stock market. That's what we do. In fact, that's exactly what we do, because when we trade the S&P E-mini, we're really wagering on the movement of the overall U.S. stock market. Now we got to talk a little bit about time frames. Predicting price movement is about finding an alignment of momentum on multiple time frames. That bears repeating. Predicting price movement is about finding an alignment of momentum on multiple time frames. Now, many traders prefer 3 time frames and use various symbolic slogans like tide, wave, and ripple, or red, white, and blue. Dr. Alexander Elder, in his excellent book, Trading for a Living, recommends separating these time frames by, quote, the factor of 5, unquote. Now, my current favorites in the realm of time frames are 1 minute, 5 minutes, and 21 minutes. Why? They're all Fibonacci numbers, and they're in the same ratio as daily, weekly, and monthly. These are ratios that we're used to dealing with in other contexts. A little bit more about higher time frames. And here I'm talking about time frames from, like, say, 10 minutes on. 10 minutes, 15 minutes, 30 minutes, etc. The pros of higher time frames include a slower pace, fewer signals, fewer trades, and less overall risk exposure. The cons of higher time frames include slower pace, which means more boredom, more re-entries on moves that are already partially spent, also larger stops, and more risk per trade. A little bit more about lower time frames. I'm talking about 1 minute through 5 minutes. The pros of lower time frames include faster pace, more signals, more trades, less boredom, and easier re-entry when a move continues after hitting all your targets. The cons of lower time frames are faster pace, more signals, more trades, but more anxiety. Now, let me pause at this point. For those of you who have not actually experienced real-time trading, you might have the notion that it just proceeds along at this awesome breakneck pace, and it's just, you know, how do you keep up with it? Oh my God, the stress, the anxiety. Well, it's really not that way. The fact of the matter is that there's little spurts of activity amidst, you know, large times of you know, not much going on. You know, there are times when watching a market in real time is a little bit less exciting than watching paint dry. So if the speed of day trading is one of the things that puts you off, take heart. It's not as fast as you think, but it's obviously a lot more fast than trading on higher time frames, you know, the 10 minutes and above. It's also important that you understand a little bit about global time. Some people think, well, you know, with Forex, for example, you can trade 24 hours a day. Well, the market is open 24 hours a day, but the trading is not that good all the time. Here's why. The International Trading Day begins in the Far East, and it takes a few hours to ramp up. The very first major market area west of the international date line is actually in New Zealand. And then, you know, as the Earth rotates, you hit, you know, Sydney and Tokyo and Hong Kong and Singapore and all those other places. So it does take a while before the, you know, the bulk of the Asian market is open. Well, about halfway through this Asian-Australian session, then the European markets begin to open up. And they're a little more compact. The area that we're talking about is a little less wide than the Asian area of the world. About halfway through the European session, Asia-Australia closes and the American session begins. And about halfway through the American session, Europe closes. And then, after the close of the American day session, volume drops off dramatically, and it stays low until mid-evening Pacific time when Asia-Australia begins to open again. So the level of activity varies throughout the 24-hour trading day. It's not evenly distributed by any means. Now, the highest volume trading time is the first half of our domestic U.S. day session. The second highest is the last half of our domestic U.S. day session. And there's even times when that last half can exceed the first half. But most of the time, this is the order. The third highest is in the pre-market, before the U.S. day session opens. I'm talking like maybe from certainly after midnight Pacific time, but also maybe more like after 2 a.m., 3 a.m. Pacific time. Now, trading after the close of the U.S. day session would be wonderfully convenient for many Americans. You know, you come home from your regular day job, the kids are doing the homework, whatever it is, and now you've got a little time to sit and watch the markets. The problem is, even though you're ready, the markets aren't. This is the downtime when the markets are in the doldrums, and it's the worst time of the entire day to trade. The volume is so low. If you are unable to watch the actual domestic U.S. day session because of either employment commitments or caregiving commitments, whatever it might be. If you're able to carve out some time in the pre-market, that would be way better than trying to do it in the aftermarket. Okay, something to think about. Now, in summary, my markets and time frame preferences are these. I prefer futures to stocks and Forex. My favorite future is the E-mini S&P because it has a low day trading margin. Now, a quick word about that. Only certain brokers who cater to the day trading crowd have the ultra low day trading margin. The firm I deal with, Global Futures, website globalfutures.com, they're one of just a very small handful. So it's not a universal thing that the day trading margins are low, but you can certainly find them. So the S&P is my favorite because low day trading margin, it has a consistent one-tick bid-ask spread, and it has relatively high volume, certainly during the day session. I prefer a triple time frame view using 1 minute, 5 minute, and 21 minute charts. I prefer to trade the U.S. day session and occasionally in the pre-market prior to the day session open because of the higher volume and volatility during those times. Now, let's take a look at the more complex topic of our three today, which is how to predict market movement. Now, I had a number 1 here because I anticipated having more slides, but as it turns out, we're going to go straight into some charting visual aids here after this. But all of the important stuff is right here on this slide right here. So take all of this to heart. First of all, remember how to eat an elephant one bite at a time. I will remind you of that as we go forward. Here's another important truism. All movement is relative and time dependent. For example, price is up or down only in relation to its previous position at some point in the past. And definitely remember this cosmic truth of trading. Now, if you've seen any of my previous webinars, you know I talk about cosmic truths of trading from time to time. There are very few, really, and they are statements about trading in the markets where you can actually use the terms always or never, and there are no exceptions to that. So one of the cosmic truths of trading is that price is constantly oscillating up and down on all time frames. And that is why we speak of rallies and pullbacks, sell-offs and bounces, impulse waves and corrective waves. That's because the market's always going up and down. And even movement that appears sideways on a particular time frame is really up and down oscillation if you look at it on a smaller time frame. So take these to heart. This is an important set of principles dealing with how to predict market movement. Now, what we have here is a bare bones OHLC, open, high, low, closed bar chart. This happens to be a 1 minute chart of the S&P E-mini. It's also using the day-only session template, and you can see there's a red line right slightly in the middle here. What happens is the market ends at 1:15 p.m. Pacific time, and it then reopens at 6:30 a.m. Pacific time the next day. This session template takes out all that go nowhere, for the most part, aftermarket and pre-market movement between one afternoon and the next morning. Now, there's pros and cons to using this type of session template, just as there are pros and cons with everything in trading. But one of the pros is that to the extent that there are patterns being made in the market, you can see them more clearly this way because it cuts out all that sort of unrelated activity that goes on in the wee small hours of the evening and morning. Now, let us proceed on. Right now, what have we got? We've got this continuum of movement, albeit with this little gap here, but you got this continuum of movement. This is the elephant, basically. How do we start eating this elephant? How do we break it down into meaningful chunks? Well, the first place is to create the trend-defining moving average. This tool that I call the trend defining moving average has a very specific parameter. It's a Fibonacci number, and I would use it in any time frame. This happens to be the 1 minute chart. If I was looking at a daily chart, I would use the same length or look back period or parameter for the trend definer on that chart. How do I know this is an appropriate trend defining moving average? Look at how it naturally acts as an area of support and resistance. The price is literally sitting right on top of it. When we break above it, it comes down, retests it, bounces up. Here, it's as though we're drawing a line here. So it's a natural boundary between the oscillations of the price. The true direction of this price on this market, as weird and erratic as it looks, is this line. This is where the price is truly going. And what happens is, it's like a pendulum swinging past a midpoint. It goes up above it, but at some point the rubber band gets stretched just so far and it snaps back and swings back on the other direction. Then this way, then that way, then this way, then that way. But if you smooth it all out, this is where the price is truly moving. This is the direction that it's going. All right, let's... We've done something to break the elephant into smaller chunks, but these aren't really bite-sized yet. What else can we do? All right, here I've added an indicator called the parabolic SAR, another brainchild of the brilliant Wells Wilder. This is actually based on 5-minute data. That's why my chart template here is called a combo template, because it has both 1 minute and 5-minute data. The parameters of this parabolic SAR are such that it will change direction at or about the point at which price crosses the trend defining moving average. And I put it on there so that it will help us visualize these chunks of movement. I call the chunks of movement carved out by the parabolic momentum modules. So you can see we have bullish modules where the price is above the trend definer, which in turn is above the parabolic, and we have bearish modules where the price is below the trend definer, which in turn is below the parabolic. Now, notice one thing. All of these momentum modules have either a highest high or a lowest low. Sometimes the price will make several stops at the same price level, in which case the first of those in time will be the high or the low. But in these cases, I think we've just got one. This is the highest high of all the price activity within this bullish module. This is the lowest low within this bearish module. Highest high, lowest low. Now this one has a question mark on it because this one is still in progress as of the time this chart was made. It turns out that it was the highest high, but in any event, that's why the question mark. So another cosmic truth of trading is that every bullish momentum module will have a highest high, and every bearish momentum module will have a lowest low, without exception. And if we connect them with straight lines, now this low is off the chart, but it connects to this high, then to this low, this high, this low. This is what I'm talking about. Markets oscillate up and down on all time frames, and they do so constantly. And these represent the directions in which we're going to be trading. When does a market go up? The answer is when it stops going down. When does the market go down? As soon as it stops going up. This is what prices do. This is what you have to really understand and appreciate. Every market can use a trend-defining moving average. And what happens is sometimes the oscillations around it are small, and that's when the trend definer gets very flat and horizontal. But other times you'll have these wider swings. And these are the swings that we want to trade. Now, you might prefer a higher time frame. You can't really get any lower than 1 minute. But this is how markets work. And then it just becomes a matter of which tools do you use that are going to allow you to see this and take advantage of it. Well, I have quite a few that I like, and I'm going to show you some more right now. The next thing I've added is my Donchian channel. Now, there's a lot of channel indicators, Bollinger Bands, Keltner channels. The Donchian channel basically looks more kind of linear and angular, and one of the things I like about it is it makes it very easy to instantly spot highest highs and lowest lows. With very few exceptions, highest highs will always be at the left-hand corner of the upper Donchian channel, and you will see a continuation of the horizontal from that point on. Lower lows will be at the lower left-hand corner of the lower Donchian channel, and you will also get that horizontal continuation to the right of the low point. So this is another way that we spot the turning points. Now I've added a couple of simple moving averages of the closing price. Whoops, let me go back. I didn't mean to change so quickly. The white moving average has the same parameter as our Donchian channel. So it is essentially the backbone of the Donchian channel. The navy blue is essentially kind of a substitute for the price bars themselves, and it allows us to see the price bars a little more clearly than just to have them floating in space as bars. What you'll notice is that prices are going up when blue is above white, and the price activity is in the upper half of the Donchian channel. Prices are going down when blue is underneath white, and the price activity is in the lower half of the Donchian channel. Now, we have these big parabolic modules, these momentum modules based on the 5-minute parabolic. But they're not really bite-sized chunks of the elephant. It's more like a big slice of the elephant has been put on the plate, and now we have a smaller chunk to deal with, but we really can't get all of that into our mouth at one time. So we have to carve out still smaller chunks of the slice of the elephant. That's what we do by adding a faster parabolic module, which I have colored red. And you will notice that when prices are rising, you will have a red, white, and blue momentum module with that bullish alignment of red, white, and blue from the bottom up. And when prices are falling, you will have a bearish alignment from the top down. Red, white, and blue. Why red, white, and blue? Well, aside from being a patriotic American, I also noticed long ago that we seem to be sort of pre-programmed, at least in this country, to think of those three colors in that specific order. You go up to somebody on the street who's either a native or has been here for a while and say, name the colors of the American flag. I guarantee you that 99 out of 100 people will say red, white, and blue in that specific order. You will not hear white, blue, red, or blue, red, white, or any other combination. In fact, to me, it actually sounds weird in any other order but red, white, and blue. So since our brains are already programmed to think of those colors in that order, I figured let's use that to our advantage. Red, white, and blue from the bottom up, I want to be long. Red, white, and blue from the top down, I want to be short. Now, I'm going to show you probably one of the easiest and most reliable techniques I've ever learned in 30 years of trading for capitalizing on price movement. Now you see these numbers? There's nothing but ones, twos, and threes. These are not Elliott wave counts. These are something called 1, 2, 3 tops and 1, 2, 3 bottoms. And that's a technique I learned from a fellow by the name of Ken Roberts. And we'll come back to Ken in just a moment. Now Ken actually kind of borrowed that from Charles Dow of Dow Jones Industrial Average fame. He was the first to note this pattern, and he called it a failure swing. Let me tell you how it works. You'll notice that all of the highs and lows, the turning points that we identified previously, well, not this one because this one is, like I say, not finished at the time, but all of these are the starting point for this pattern. Well, let's begin over here on the left. Here's a 1, 2, 3 top formation. What happens is your highest high is your point number 1. And then the market sells off and creates a number 2 point. Then it turns and goes up in an attempt to make a new high. But the second high stops short of taking out the first high. And once it comes to a stop and it turns around and sells off, now you know this is your number 3 point and it's time to get short. And the odds of a follow-through that is going to be sufficient to be profitable is huge. Now, if you are an Elliott Wave fan, you might think, oh, well, that's wave 1 and this is wave 2, and now you're selling off into wave 3. Possibly, you might end up with that wave count if you're an Elliott Waver. But so many people are sort of reluctant to go in that direction. Here is a much easier technique than Elliott wave counting. We're going to talk about Elliott wave counting, and I think it's everyone who's serious about trading should know a little bit about it. But if you're still struggling with it, here's a much easier way to begin. The 1, 2, 3 top is the pattern to look for in every short trade that you ever take. And look at the 1, 2, 3 bottom. Works the same way in reverse. Your lowest low is the 1 point. It rallies up to a number 2. When it stops and sells off again, you're waiting to see if this second low is going to take out the first one. And when it doesn't and it turns around and rallies, you want to get long. Because, like I say, these are tremendously reliable programs. And we got it from this man here, Ken Roberts. I learned about it back in the 1980s when I first started trading. Long time ago, I used to publish a newsletter for my students. You can see this one's over 7 years ago. And this is one of the first handouts that I send to all my new students because the 1, 2, 3 top and 1, 2, 3 bottom formations are so very valuable. Now, at this point, everybody's going to stop the video and read this. But if you want the whole report, come and become my student. Now, here's the same chart again, but now I've taken the 1, 2, 3s away, and now we have a full-blown set of Elliott wave counts. And I don't consider myself to be a master of Elliott wave. I don't even know if masters of Elliott waves exist because it is very complicated and subjective. But I can tell you that the counts that you see on this chart do not violate any rules or guidelines of Elliott wavedom. And consequently, the arrows, the trade arrows, are in the same spot that they were before with the 1, 2, 3. But now you can see, in this case, we're going from wave B down to wave C. Here, we're going from 2 up to 3. Here, we're going from 4 down to 5. Here, we're going from C up to 1. So you get the same results, but the 1, 2, 3 tops and bottoms is just a little bit more simple. Now, all of this is based around the fact that our price is going to be above and below the trend-defining moving average all the time. The other thing is that when you go from high to low or from low to high, the space that lies in between is going to be some form of an Elliott wave pattern. From this low to this high, according to what I've got here, we have a perfect bullish 5-wave impulse pattern with an extended wave 5. Here we have a perfect ABC 3-wave correction pattern going from larger wave 3 to wave 4, and so forth. What lies between the extremes is going to be an Elliott wave pattern. That alone is going to help you figure out how to use Elliott wave a little better than you might expect. Now, imagine we have this pattern very nicely completing, But wave 5 is actually part of a different day than the preceding part. And what lies in between, if we were to look at the all-session chart, is a lot of sideways consolidating, going from the afternoon into the evening and the early morning and all of that. But here's something that you need to remember. Every cycle system, whether it's Elliott wave, the delta phenomenon, or anything else that you might be familiar with, all of those were developed in the 70s and the 80s prior to the advent of electronic trading, back when the day session of Open Outcry was the only trading there was. And so it's natural for these patterns to be based on that information. And the other thing is that there's really a different crowd. The people who trade during the day, many of them, like me, stop trading at the end of the day session, and they don't come back until the morning. Sometimes they come back a little earlier than the open, but they're not there all night long. There's very few people there all night long. So in a sense, when we quit here, we really don't pick up again until the open of the next day session. So it's the same group, it's the same continuum, and what went on in the wee smalls doesn't really count. So if you're inclined to use a cycle system, you might want to try looking at the day-only session template. Now, everything we've talked about so far has been all in the upper panel of the chart. What about the lower panel? Is there anything there that can help us out? Well, I like to use a dual MACD. Oh, before we get into that, though, here's a quick word about Elliott wave. If you'd like to brush up on your Elliott wave just a tad, I gave excuse me for bragging, but a pretty good webinar on that subject on April 19th. Elliott wave, just the essentials. So again, go to Pacific Trading Academy, blog, Mentor Mike's Market Movie, April 19th. Watch the video. I'm going to reprise this video on July 9th in the next video I'm doing for Ninja Trader. Okay, now moving on. Here is the lower half of this chart. We've still got our Elliott wave stuff on here. Notice that I have a pale blue MACD histogram with a signal line in red. Notice the correlation. When well, first of all, my trend-defining moving average is a dashed green line. The zero line on the MACD is a dashed green line. See any correlation there? I hope you do. All right, when the price activity is above the trend definer, the big histogram is above the zero line. Price breaks below the trend definer, it does two things. It flips this big parabolic now, so that now we've got a bearish module, and our MACD goes below its dash green zero line. Price above trend definer, histogram above zero. Price below trend definer, histogram below zero. Getting the pattern here? You'd be surprised. Some people have trouble seeing the correlation even when it's pointed out this obviously. Now, I use a second MACD, which marks the oscillations around the white swing-defining moving average. I use a zero line that's red because when the price crosses the white MA, typically you get the flipping of the red parabolic. So let's start over here. You've got a bullish red, white, and blue alignment, and you've got your MACD histogram above its red zero line. Little pop below, and here's your little pop below. Above, above, below, below, and so forth. Here's this great big drop here. The price drops below the white, comes way down to this low, comes up, goes above the white, below the white, and back above. We have this same thing going on here. Comes all the way down, above the white, below the white, and up it goes. So in general, every time you see a bullish or a bearish parabolic module with the red, white, and blue, you're going to see it down here as well. Now, you put the two together, and I find this really easy to read. Some people might struggle with it, but look here, for example. Here we have this big bullish area where the price activity is above the trend definer. So the light blue histogram is above 0. And at this point, we get this beautiful break to the upside. As the blue crosses the white, it also flips the parabolic into its bullish posture, and you have a red, white, and blue alignment from the bottom up. And this would have been a terrific long trade. And look what we have here. When the price went below the blue here, when the blue went below the white here, you've got your faster MACD coming below 0. But the big one stays above the whole time. So at this point where we got the faster one coming back above its 0 line, what have you got? You've got an alignment of the two MACDs. The faster MACD and the slower MACD are both above 0. And you've got a red, white, and blue momentum module on the price. What do? We go long. Duh. Over here, it takes a little longer for the big MACD to catch up, but we flip the big parabolic. So when we sell off at this point, we could get short about here. Now, we're already down here on the stochastic, but that's okay. I meant the MACD, rather. So we look for the alignment of momentum on multiple time frames. Now, one of the things about the big histogram is that it's marking those big chunks, the slices of elephant on our plate, and these are the individual bites that we take. So we know that we're trading between the highs and lows of these bigger chunks. And so when we have the histogram, the big histogram above 0, we're looking for highs. When we have the big histogram below 0, we're looking for lows. Now there's a whole lot of other little tricks and tools that you can use to find those highs and lows, but hopefully I've given you a new way to think about how prices move, which is the constant oscillation from high to low. Now, quick reminder, in part 2 of this series, we're going to discuss the next 3 questions, which are how to maximize your win percentage, how to substitute mathematics for emotions, how to systematically grow your account from beginner to Mentor Mike's gadget level. And again, gadget stands for Grand Day Group of E-mini traders. Now, let's talk just a little bit about that. I'm looking for a few good traders to join Mentor Mike's gadget. I can make no guarantees, but my personal goals are these: to help every student become a competent and confident trader with a win percentage of 90% or better. To help most students earn enough to pay for the course within 3 months. Most students. To help some students earn $1,000 per day or more within a year, and to help a few students earn $1 million within 5 years. Does that sound just outrageously grandiose? Probably. But consider this. If you can get to the level of earning $1,000 per day, and you can maintain that average, in the course of a year, you will have made about $250,000. So you keep that average up, and making $1 million in 5 years is not out of the question. Now, I'm perfectly serious about this. If you're interested, you need to do something about it. You need to go to that link right there. And if you click on that link, you'll go to this page on the Pacific Trading Academy website. Now, how do you get there? You go to enrollment and Mentor Mike's mentoring course and trading room, because in addition to the course, we spend 2 full days out of every week trading in real time. Now, this will tell you all about it. And when you're ready to look at the money part, click on price and payment plan, and it'll take you right there. Course costs $4,990, payable in 2 installments, $29.95 and $19.95, 30 days later. You get what you pay for, folks. It's worth every penny, I assure you. You decide to enroll, you get a page like this, you fill it out, and you're pretty much good to go. You'll hear from me about scheduling the first lesson. You'll get instructions on how to access 8 video lessons that you can use to prepare before our live one-on-one. And you'll get login information for the twice-a-week trading room. Now, the big question, is $1,000 a day a realistic goal? Okay, certainly a fair question. Let's take a look. I'm going to show you my personal charts for this past week, which also happened to be the first trading week of the month of June. Here's Monday. Made 2 trades. Had other things to do. Only had time for these 2. Made $567. Ooh, gee. Little short of $1,000 a day there. This was our first trading day of the week, and made even less, $196.50. Finished in the money. A lot of you would probably be happy with $196.50, but I have to apologize for it. Now, things pick up on Wednesday, $1,284. Now we're talking. Thursday, our next trading day, I made $1,776. How very patriotic. And Friday, I finished the week with $1,375.50. And folks, these numbers are all net of a $6 per contract transaction cost. This is what those scores added up to, and the 5 days gave me a weekly average of $1,039.80 per day. So yeah, $1,000 a day is very doable. Now, you might say, well, yeah, okay, fine. You've been doing it for 30 years and teaching people for 14. Can students do it? Well, on April 10th, I posted this on my blog page, praising my student Greg O. from Florida, who became the first official Gadget member by making more than $1,000. On that particular day, he made $1,175. Now, Greg has sent me a ton of his personal charts. I picked 5 at random, and I'm going to show them to you right now. This day, he made $2,625 trading 3 contracts. Here, he made $1,037.50 trading 3 contracts. Here, he made $1,175. I think that was probably his first day, also trading 3 contracts. Here, he had a stellar day, $3,087.50 trading 3 contracts. Here, he made $1,112.50, and he had bumped it up to 9 contracts that day. Now, those 5 days add up to $9,037, and that should be 50 cents, folks. The decimal's in the wrong place, which is an average of $1,807.50. Now, Greg's a real smart guy, and he's a very dedicated, diligent trader. But you know what? I'm sure there's others like Greg out there. So if he can do it, perhaps you can do it too. Notice I said perhaps. We'll come back to that thought. Now, there's my blog page on Elliott Wave again. I want to just mention a little bit more about Elliott Wave before we leave that topic. A lot of people put off learning Elliott Wave, or they claim that there's nothing to it. I think that you have to have a basic understanding of Elliott Wave to really maximize your trading potential. And in the trading room, we've recently started using the day-only session template, which makes it a lot easier to see what's going on from an Elliott Wave perspective, because the patterns link together one day after another. Now, this was Monday. This is my take on the Elliott Wave pattern for Monday. And then continuing on with Tuesday, it looked like this to me. And notice I'm also drawing my lines from highs to lows. Now, sometimes I'm uncertain when we end the day. I put the question marks there. It's prudent to do that. But if you end the day with a well-drawn pattern and your wave count does not violate any Elliott Wave rules or guidelines, then there's a pretty good chance that that's a legitimate count, and you're going to be able to start from that point the next day. I also know that if I end on a high, one of two things is going to happen the next day. Either the market's going to go higher and this high is going to end up being higher still, or if the market sells off, then this high is confirmed and I'm immediately looking for a low. And that was a low that day. This market went down the next day, and here was that low. Then up to this high, down to that low. Now we're up to the 4th of June, and the 5th, and the 6th. This was Friday. Each day was a continuation of the pattern completed the day before. And when we have an idea of what may happen the next day, doesn't that improve your odds just a tad bit? I think it does. So one of the things that you're going to get from becoming my student is, even if you have resisted Elliott Wave, you're going to soak up a lot of it just by osmosis. And every day I send out an email to not only my students, but to anybody else who's requested to be on my email list. I send out screen captures of my charts, and lately I've been including the Elliott Wave charts. So you're going to soak up a lot, even without trying, and before long you'll be counting waves of the best of them. And you'll find your trading will improve as well. Now, if you've got questions or comments for old Mentor Mike here, or you want to get on my daily update email list, you can reach me at mentormike@sbcglobal.net. Now, I want you to include your phone number and your time zone, or better yet, just become my student and enroll directly online. Now, I want to leave you with this. Some of you have probably heard of the 80-20 rule. It's also known as the Pareto principle. It's named for an economist or mathematician. I'm not sure what he was, but he was an Italian fellow with the surname of Pareto. It's also known as the law of the vital few. And what it means is that in most events, roughly 80% of the effects come from 20% of the causes. For example, in companies with large sales forces, it's usually the case that 80% of the sales are made by 20% of the sales force. Now, this rule can be applied generally in most aspects of life, including trading. 80% of traders consistently lose and 20% consistently win. You might have heard that only 10% of traders win. It's actually a little better. It's about 20%. And I have studied statistics in a number of trading contests, some of which I participated in and some of which I just read about. And this 80-20 rule holds pretty consistently. So my goal is to teach my students to be in that 20%. Greg O from Florida is definitely in that 20%. In fact, he's probably in the higher level of the 20%. But you know what? The truth is, not everyone has what it takes. So you need to really kind of examine yourself, do a little personal introspection. Everybody wants to trade. Everybody thinks it would be a great lifestyle, and let me tell you, it is. But not everybody can do it. Not everybody has the aptitude. So think very carefully. Have you generally been in, the top 20% of any competitive groups you've been in? Well, if you feel that you do have what it takes, then you need to enroll with me, and you need to do it now. If you're honestly of the opinion that you don't make the grade, well, okay. Good luck anyway. So, I hope that you will go from viewing this presentation to going to enrollment, Mike Bridges Mentoring Course and Trading Room. Read all about it, think about it, and then enroll. That's it for me. Again, I sincerely apologize if you were inconvenienced by not being able to see the live show, but hopefully this presentation has given you something of value. So thank you very much for your kind attention, and I hope to talk to all of you very soon. Bye-bye.